welcome to the show. Thanks for coming. How you doing?
I'm doing great. How you doing, Max?
I'm doing fantastic. So we're going to get quite the dose of, let's just call it volatility, I think, right? And we're going to get some SPX, I'm assuming, and some spiders and some VIX. So that's your specialty. Agreed? Somewhere in that ballpark?
Yeah, I mean, I would say my specialty would be economics and identifying relationships and efficiencies. So.
Okay. And then tell me a little bit about, just give me a little background on yourself. Let the folks know, your background, how you got into this business, what the fund is all about, even, hey, now's the time to pitch. Give me a pitch on how do they sign up? What's the deal?
Sure. So Ad Dam Funds is a derivative-based registered investment advisor. And we got into, it's a family run. So it's my wife, Jill, and I. We got into this business because I have an economics degree, a master's in economics, and I'm very much in. I like to find relationships, and I like to find cause and effect, and economics is about that in both life and markets and incentives and people. So because of that. And I have a passion myself for kind of math oriented. So I was very much attracted to options because options allow a much more dynamic way to invest your money. So I got into the business. I just kind of learned on my own. I got mentored, and I've been doing this now for over 10 years, 10 to 12 years.
Okay.
And I started getting pretty decent as the more and more I learned. And so then I started contributing to a couple of message boards, started recommending maybe different ways to invest in certain companies that people like using options. And people started texting me or messaging me and asking, well, so what is your AUM? And so what company do you work for? And I say, I just have my own, like I'm not a company at all. And so my wife and I sat down and we decided, let's try to do this. Let's give this a shot.
Good.
And yeah, we got registered a couple of years ago, and we've been doing well since.
Good. So let me ask you a question. So, is your wife also registered? You said you're partners.
Yeah, I mean we're partners because we started up the company ourselves, but she is more about marketing, administrative. Kind of like my compliance officer and not just that damn. So
wait a minute, she's a compliance officer?
No, like she's in charge of keeping me straight.
Yeah, right.
But
I know how that goes. Okay, good.
Yeah, so I mean, she she keeps me honest. And, don't talk about this. But she does all the marketing. I have a monthly newsletter that comes out at options expiration, and she makes it look pretty. This beautiful swirl behind my head, that's all her. She's ending.
Good.
So she does like all the support things, and I just the trading guy. So
got it. Good. And so you mentioned earlier, and then we'll get into, I think you have a presentation to go through, which is going to be really interesting. I think you mentioned earlier, you're derivatives based, right? So your strategy doesn't involve any actual equities, or does it involve some equity and option overlays and strategies? How would you describe that?
So it obviously depends on everybody's risk tolerance and what they want to do with their fund, or with their portfolio. There are some where it is just strictly cash secured puts, so I'm just selling puts on stocks, and sometimes they get exercised. If it reaches that put value, it'll get exercised. And that's not a time to panic. That's a time to sell a call on it. So sometimes I do those kind of strategies. So there's some equities, but it's mostly options. That's a differentiator for our company.
Good. Yeah, it's good. We typically on our end don't see a ton of advisors who use options as the main focus, which to me, I love it. I think it's a much better do. There's so much more you can do with the options world, in my opinion. So it's nice to see, you really doing this, this part of it. I love it. Great work there. Good. How about, you want to make a plug now, or you want to do it at the end in terms of how do people find you? Is there
Oh, I mean, you know, and maybe I'll do the plug at the end. Just
okay,
that, you know,
perfect.
I wanted to plug a bunch of like my sources and
Got it.
where I
Okay.
contribute to. So,
All right, good.
yeah, this is a little bit next level, but it's something that I feel that even beginners before they start trading need to know,
Yep.
because it's foundational for anything trading with options.
Got it.
So that's my wife and I.
Great.
Um,
That's a good, I love the logo too. Very nice.
yeah, she's
Always in
does a great
in
job.
our business, we always have disclosures and disclaimers. Okay,
Yep.
good.
Yeah, I have
I
to.
can see you follow the compliance officer's rules. That's good.
Yes.
All right, let's rock.
All right. So this first slide, I just wanted to define some terms and introduce to some of the products that I'm going to be talking about. Um, so this is the volatility product landscape. Volatility itself is the premium that is assigned to the options, the extrinsic value to, in this case, I'm going to be talking about the S&P 500. So I'll say SPX, the premium on the SPX options.
Okay.
They're found through through pricing models, many different. Every individual uses their own. The most popular would be the Black-Scholes model, and volatility is one of the inputs. The other inputs being the underlying, the price of the option, and interest rates and time. So what we're going to be focusing on is volatility, because that is the most dynamic of those variables that you have to think about when computing the price of options.
Okay.
So but there are many ways to trade volatility. And there are many products out there, and I kind of wanted to introduce at least a little bit to these products. So the first are options themselves. As I said, the options are priced using volatility, and these are contracts on the underlying. So if you're here, you probably know what options are. So I will go a little bit quick through this part. But the three main inputs are the sensitivity to the underlying, the expected volatility in the future, and then time. As time gets closer, the volatility, the uncertainty goes up and down a lot less, because there's less that can happen in less amount of time.
Right.
And these options are offered by market makers like you used to be, Lex. They isolate volatility by hedging with futures, with SPX futures, SPY, or maybe a basket of equities if they want to try to recreate the SPX on their own.
Okay.
So that's very important to know. There's also VIX Futures, VX Futures, and those are kind of derivative contracts on VIX. And what VIX is a measure of the implied volatility of SPX options. It's kind of, each option has its own implied volatility, but this is a measure it's offered by the Chicago Board of Options Exchange, and it is a formula to try to narrow all those implied volatilities into one concise number.
So, okay, let me ask a question. Do they measure the VIX? Does the VIX measure the 30-day SPX option? Is it geared to a term structure?
Yeah, it's
over at SPX.
Well, 30 calendar days, yes, but I think it's like 20 trading days, I think, technically.
Okay, so that's what that VIX measures of SPX options, correct?
Yes.
Okay.
It's so when you see VIX, I mean, when you listen to financial news like CNBC, they call it the fear index. And the reason why they call it that is because if you see implied volatility, kind of just think of those words, implied volatility, they're saying that there is something between now and the time that these options expire that could create some market volatility. And as most people are using this as an insurance on their portfolios, they would, kind of, if they would charge more premium. If you think about, say, like a hurricane coming on your house, and you decide to buy insurance as the hurricane is coming to your house, that insurance company is going to charge you more because there is already an event that is coming that may ruin your house.
Yeah, that's.
So
Did you make that analogy up on your own? Because that's the one I always use, and I'm not a mathematician like you. That's amazing.
yeah, I would say I'm an economist, but I mean, I do. Yeah, I guess
So that's interesting. So here's the deal, though, and let me put it this way. Back to our hurricane analogy. It's not that the insurance company won't insure you; you will pay dearly for it. Correct?
right.
So
Yes.
conversely, if you're willing to pay $10 million for your insurance policy, they might sell it to you for 10 million bucks, especially if your house is worth 5.
Right.
So
Exactly.
keep that in mind as a trader. You know, we set the insurance premiums. We market makers, right? We were the premium sellers, and we would trade anything that you wanted to buy from us at the right price. Quite frankly.
That's right.
Okay.
And I think though, so because of that, I was going to get into this more in the next slide, but because of that, VIX can be seen as a measure of market maker liquidity. It's your willingness to offer these options. And the less you're willing, the more you charge. It's the amount of risk you're willing to take.
Understood.
So that's why they call it the fear index. It's kind of I never like using that term because it's kind of a misnomer, but you hear it a lot, and so I kind of try to.
Yep. Well, yeah, I get it. I think you're right. You know, when you think about what it really means, it probably isn't, but I think it's a good way for people. You know, you see it on CNBC a lot, the fear index.
Right.
It settles in for folks who might not understand this level of it, and they get fear. You know, they go what that means. So that's good. That's certainly appreciated.
Yeah.
Sorry, go ahead.
So VX futures also have a settlement date. I think it's the third Wednesday of the month, and they settle based on the value of the VIX at settlement. So you will always kind of find the VIX at a different level. Well, not always, but when the VIX is at a different level than the VX futures, you can kind of insinuate which way the futures are going to go, or how many people are actually hedging against their portfolios, how much insurance is being purchased over certain measures of time.
Okay.
So, but I also wanted to stress that it's not realized volatility. Sometimes people will catch a glimmer that there's always a difference. There's always a premium between most of the time, there's a premium between what market makers charge for these options and what the actual realized volatility is. And there's usually a gap where the realized volatility is lower. And people always want to try to capture that variance risk premium. And they think that VX futures is the way to do it, and it's not. So I kind of always want to stress to people that that's the case.
Got it.
So VX futures are also offered by market makers, and they hedge using options that mimic the VIX, pretty much. And then there's options on the VX futures. It's options on futures on options. And but it's listed under the VIX. You cannot go into the VX futures and buy options. You have to go under the VIX to buy VX futures options. And the VIX you cannot trade itself. It is just a measurement. It's just an index.
Right.
So.
Right.
And then there's volatility ETNs, like ETN being exchange traded notes. This is your VXX, your UVXY, and they sell the near-term futures and buy the next expiration future. And so basically they're trying to recreate a certain tradable security on volatility.
So they're doing this on a daily basis, I think, right?
Yes.
The VXX, each day they're doing whatever it is, 1/127th of that trade, right? They're taking out a piece of that every day. So what typically happens, I traded VXX a lot in my day. It's a decaying index.
Yes.
So it naturally decays over time, I think.
Yeah, and the reason why it decays is because, I mean, we'll probably get into this later, but the reason why it decays is the near-term VX future most of the time is lower than the next term.
Right.
So if you are selling that decaying VX future and you are buying a more expensive future, it just keeps getting more and more expensive, and so VXX goes down.
Good. That's exactly right. Good. Perfect.
And then there's short volatility ETNs like SPXY and SVOL, which is a new one.
Mhm.
And they are just heavily hedged short VX future contracts, trying to do the opposite. There used to be one called XIV, which in February 2018 got so overloaded that it crashed. Again, that was an attempt to try to profit on the contango, that difference between VX futures.
Mhm.
And they were trying to profit on it, and everybody loaded into it. It made a lot of money, and then in one day it went from 98 to 0. So,
Oops.
so people and banks are very cautious on doing.
Right.
There's also I also wanted to mention, it's not on here because it's not available to retail traders, which is variance swaps.
Right.
Institutions, and really kind of what VIX is the fair price for a variance swap.
Right.
Institutions, hedge funds will sell those, and that is really the only way to capture that variance risk premium. But
Got it.
so
We're getting a question, Jason. Let me ask this question while we're on this topic. I want to make sure we cover it. Why is it so common to short volatility ETNs? Does this practice artificially inflate the market? Any thoughts there?
So we were kind of discussing before how volatility ETNs are naturally decaying because they are selling a less expensive product and buying a more expensive product.
Mm-hmm.
They're trying to, it's supposed to be used, it was designed to be used as a hedge to long positions,
Mm-hmm.
and trying to be simple in doing that.
Mm-hmm.
And the reason why people short it is because it has that natural decay. When people short it or add to it or take away, it doesn't really affect the market so much, because what they do is they add on or release that same position in the VX future. So if they have another pile of money that is unused, they will mimic the position they currently have. Right?
Yep.
So,
okay. Makes sense.
So yeah, so the reason why, does it affect the market overall? Minimally, but it does, inflate the VX future value, and it will, but only minimally. So
Okay.
I don't think the actual transactions on the ETNs matter very little.
Okay, good. Understood. Okay, thank you for that.
So the next one, so as an economist, as I became comfortable with the market, or I guess you could say uncomfortable with the market, I kind of just wanted to answer the question, why does the market go up or down? Like on any given second,
Mm-hmm.
why does it go up or down? And
have you figured that out, by the way?
No. Well, I mean, sort of. I mean,
can I be one of the first to know when you figure that out? Can you just let me know that one?
So I mean, I did this in my economist way, and so what you learn in school or what you learn on, and just financial kind of thing, is maybe it's the fundamentals, maybe it's forward PE ratio of all the components.
Mm-hmm.
It could be credit. Could it be the Fed balance sheet? You hear that a lot.
Mm-hmm.
Maybe other GDP, some other economic indicator, macroeconomic indicator. And so what I did is I did a lot of regressions. I said, all right, does forward PE match the S&P 500 change?
Mm-hmm.
And no. I did a lot of these regressions, and the correlations were not very good. I did one on bonds too, which a very popular financial planning strategy, risk parity.
Right.
Invest 60% in equities and 40% in bonds.
Mm-hmm.
And when equities go up, bonds are supposed to go down, and vice versa. It's supposed to be a good inverse correlation. And if you look in the past couple of years, bonds have skyrocketed, and so has the S&P 500. And even in the drops, in the big drops, you'll see that they both go down together as well.
Mm-hmm.
So I mean, there sometimes that correlation has been positive,
right.
Which means that your risk parity is not actually parity. So be very careful. Think about that with your financial planning.
Okay.
Yeah. So I mean, and GDP is, we've had very flat GDP for a while now, and the S&P 500 has gone up far more than GDP has.
Mm-hmm.
So, I mean, nothing really had a good relationship. however, VIX did the thing we were just talking about, the implied volatility on the S&P 500. It had an extraordinary correlation of 0.63 R squared. And that kind of means that about 63, it contributes about 63% to S&P 500 movement. Now, of course, it seems very, I mean, it's very robust. There's always times and when it is not, and there's always that other gap. But you pretty much, when we're on cruise control, you can reliably predict what the S&P did if you gave me the VIX. You can see this little formula right here. Anybody who's watching this, write this down. And
it's right here, right?
Yeah, I mean, yep, that's it right there.
Okay. All right, explain to me this formula. So the VIX SPX relationship, though, SPX goes up, VIX goes down generally.
That's right. Yeah, if you're looking at this chart, you'll see that that on the x-axis right there is the VIX change.
Got it.
And the reason why I do it in points is because the way it's measured is a percentage. So if you take a percent of a percent, you're not actually getting the correct. You're not getting the correct. You're not comparing apples to apples.
Okay, I understand. So let me just make sure I understand that. So the x-axis is in point movement of the VIX.
Yes.
And then compared to the SPX change in percent terms.
That's correct.
That's how the relationship works. Okay, I get it.
Yeah. And this is on a daily basis.
Okay, understood.
So, I mean, and you can see it's very clustered, and it draws a very, it draws a very convincing straight line right through that trend line.
Yep,
is a good one. So, I mean, the reason why, and this could be a spurious correlation, right? So you kind of think, is the VIX causing the SPX to move? And when you consider that market makers use the SPX to hedge their implied volatility, you could say, well, there's obviously a relationship there. And perhaps maybe the market makers are the primary buyers and sellers of the SPX or the stocks that are in it. So I found this as an extraordinarily compelling relationship. And I did a lot more investigating on it to see, there's a couple dots. There's one dot way up here by 10%, but the VIX doesn't move.
Right. There.
By the way, even though this this relationship, this is over the past 2 years.
Okay.
Every dot, including during COVID time. That dot up there was the bounce from COVID. And when the dot is far away, you know that market makers are not making this move. This is something else. But
interesting. Yeah.
Because that VIX is kind of a mean reverting measure, because there's always going to be somebody who is going to be willing to sell. And then once S&P 500 starts going up or calming down, at least calming down, more people will want to step in, and I'll give you this put for a little less premium and a little less premium. So the free market kind of kicks in and begins to reduce that VIX. So
got it.
Basically what I'm saying is that this correlation implies that these option market makers are the primary source of liquidity in the market. Like we were saying before, the VIX is more of a measure of option liquidity, and it's becoming almost something like a derivative product is actually the tail wagging the dog. The S&P is moving because of the derivative.
Okay, that's interesting.
So
do you trade? Do you, in your fund, do you trade the VIX and SPX options a lot then, or is this a relationship that you use to measure something else?
I basically use this as a relationship to determine what to start looking at. I mean, especially with options, you can't just throw something out there, VIX to SPX, and now I'm going to just buy SPX when VIX goes down. It's not quite like that. Mainly what I do is I will look at the relationship, and there's a bunch of other kind of volatility related things that we'll get into later that I look at before I make a decision, saying I think that the SPX will go up very, in the short term, or it'll go down in the short term. And so this is just kind of what I'm doing is introducing people to the variable that you can look at
Mhm.
and see maybe there's a market move coming in one way or another.
Got it. Okay.
But I will tell you, I'll give you some actionable steps probably
Okay.
in later slides.
Okay. Awesome.
So yeah. So, and also I was kind of, option market makers nowadays are identifying these opportunities at the speed of fiber optic cables. So because it's
Yeah,
always mean reverting.
right.
Source pop Lex.
Yeah, no, I remember. Listen, I'm so old. I got to do this with a calculator and a bunch of cards back in the day on the floor. We didn't have all this fancy stuff. There was no fiber optics, anything. That was what you used on the weekends for, putting your car on the lift or something. Yep, all changed. Okay, wow, look at this.
Yeah, so I'm going to explain this. There's no words, so you probably have to listen. This is over the past year, since the beginning of 2021.
Okay.
The blue line is the deviation between, I'm sorry, the orange line is the deviation from this relationship right here.
Okay.
So that you'll see a very large spike up when you see a dot that's far away from this line.
Okay.
And because VIX is mean reverting, like we said, since those fiber optic cables are always humming.
Yep.
It will normalize eventually.
Mm-hmm.
So when you see there were 2 times in the past 4 months where we saw this very clearly.
Mm-hmm.
And that's what I highlighted here in green, end of January to February, and also the end of February to March. And so I enlarged it. So the green is right over here in January.
Okay.
And you'll see that the VIX overshoot went all the way up to 10, which means that it was 10 points higher than what it should have been. So the VIX went up 10 points higher than what that last formula that we saw in the prior slide, this one right here, than it should have been.
So, and just so I'm understanding, so that big overshoot, that's one of these outlier points. Is that correct?
That's correct.
Can it be an outlier point to this side too?
Yes. Yes.
Okay.
And that's when you'll see the spike down.
Okay. I understand. I see it now. Wow, that's interesting. So right away, my mind starts to think opportunity is knocking.
That's exactly right. And that's what you want to see. When you see this VIX go the VIX, not necessarily that the VIX shoots up, because that is if it's the correct amount of implied volatility increase, then you won't see this orange spike.
Sure.
You'll see over here in March, you'll see that there was a time where the VIX was actually under, or the VIX was kind of more or less correct, even though the market was going down almost 2%.
Mm-hmm.
But the VIX was reacting the way it was supposed to. So that's why it's this formula right here is so important, because it tells you what the VIX should be for every market move. And when the VIX is overshooting it or undershooting it heavily, then you can see a relationship is going to come.
Mm-hmm.
Or an opportunity is going to come.
Opportunity, right? Okay.
So I'm going to go through these 2 time periods, which, especially people now that have lived through March 2020, they are clearly not major drawdowns, but they were significant.
Sure.
So right here, this one in January, on January 27th, we saw a VIX overreaction of 10 points.
Mm-hmm.
Is extraordinarily high. Anything over plus or minus 2, anything over 2 or under -2, you want to pay attention to. That's when you start paying attention.
Okay, got it.
So this shot up over 10, and the market went down about 2%. So what that screamed to me is, there was a lot of panic. There was a liquidity issue on January 26th. But that's saying to me is volatility eventually is going to come down.
Mm-hmm.
That VIX is mean reverting. So it's going to come back to where it should be. And I did you could either do it by being short gamma. You can, sell the premium, the way overpriced premium, or you can try to, pretty much when the VIX is going very hard negative,
Yep.
the S&P will go positive. So you can either do a positive S&P, which is, a couple orders of magnitude away from the thesis,
Mm-hmm.
but very related, obviously. Or you can short volatility, either through the VXX, either through those ETNs, VIX Futures, or selling SPX options.
Okay, let me ask you a question. So how much of a leading indicator is this? Meaning, is this predictive at this point? Now, when you're at that point, you haven't seen the rest of the graph. You don't know if it's going to keep going this way, right?
That's right. That's right.
And so like if I think you said plus or minus 2, well, this is 4, right? And then this is 6. So far I'm down 2, let's call them whatever the units are. And now I'm down 4 points there, right?
Okay. So I do want to kind of call your attention. This is a daily chart.
Okay.
So you just did 4, 6, 8, but this is just connecting the 2 points of the
Understood. Okay.
The 10. But okay, you can do this intraday, but intraday, the closer it is, the less the closer in time frame, the less reliable it obviously is.
Understood. Okay, I get it now. Okay.
Anyway, that being said, though, you're right. How much of a leading indicator is this? And the real answer is you don't know for sure.
Okay.
But if you're doing something that's short gamma, I'm sorry, if you're going to be selling the premium, then you kind of want to give yourself enough time for the market to hash it out. Or you can do some other analysis. Is this because the Fed did a move, or was it a Fed move? Because of the meeting, and it turned out to be nothing, or it turned out to be something. That's you kind of have to see the whole picture in order to give it a good amount of lead time. If I remember correctly, on this day, this particular day, it was a options expiration thing, and it was a VX future expiration thing. So I kind of thought it was a little bit, I did it a shorter lead time because I thought it was going to resolve pretty quickly. But I did it for like February. Again, you never know.
Yep.
But
okay. Makes sense.
So
good. Very good.
But if it's something like COVID, you might want to do a month out. You don't want to take that risk.
Right.
And then there was this other time here in February into March. And the reason why I highlighted this one, yes, you got that spike to 4, which is over 2. And then you got the related move in SPX. It went down 2.5%, but then it recovered over 3 days to 2.5%. I find that the higher the spike in volatility, in general, the quicker it resolves.
Okay.
4 versus 10 is, that's a significant difference. And it took 2 to 3 more days to resolve.
Okay. So do you have this, is this something that you run in real time? I know you had to take a shot of this for the show here.
Yes, I mean, I have my Excel spreadsheet where I have the VIX and the SPX kind of loaded in, and it constantly updates, and I just have the formula on that updating SPX and VIX, and it'll give me kind of an alert when it's over 2 or under -2.
Nice.
Yeah, so it'll ding and whatever, and then I'll look and I'll say, oh, okay, let me see, is this something temporary? Is it maybe a measurement error? Is it what's going on here?
Right.
And,
very good.
Yeah. So yeah, I have an indicator that kind of alerts me when something like this is happening.
Yeah. So let me just to kind of reiterate here. I don't want to miss this point. So the bigger move here, the quicker the kind of the snapback, right? Okay.
In general, and if you think about it, it's because if you think right here, this 10-point increase, that screams opportunity for a market maker. He's saying, whoa, that people are willing to pay a ton of more money than the S&P is implying at this point. So that screams opportunity. More people want to pile in. Here, that with that 4 spike right here in February, there's a little bit less of an opportunity. So it took a little while longer to settle down.
Right. Okay. And you said this is a year of data. I'm just looking at it real fast. It looks like,
Well, this is just till 2021. I mean,
okay, I see it now. I
yeah,
have my picture and your picture in front of it. I got it.
yeah, and this here is since the beginning of 2018. I like to measure since
Yep.
the the volatility crash of XIV, because that's
Okay.
when the regime changed a little bit. So,
Okay.
but that the regression formula there is not changed much at before 2018 or after. So it's pretty much been constant for years. Like that.
Great. I see. Okay, good. Yeah, I looked at I couldn't see the dates, but I see them now. So on my screen. Got it. Yeah, that's interesting stuff. You look at it, there's only 2 occurrences above the 2 line, right? During this period.
Yeah, during the past 4 months. Yeah.
Yep. Interesting. Okay. Very cool.
So the next one, I wanted to talk a little bit about the COVID drop to see, could we have seen this, or could we have seen when the bounce was going to happen during COVID during this time?
Okay.
This is an example in the beginning of it here in 310 when you started seeing the tremors. The peak was it was like around 8 twice, and you see it snap back twice. At this point in time here, I'm just looking at the green. It peaked twice, and obviously this was when COVID started to kind of get some popularity, or not popularity, started to become news. So there's people that are maybe market makers were not overreacting quite much yet, and then all of a sudden we got the big kaboom right here, which was negative 10% on the S&P. And now you can see that the overshoot, while it was high, it wasn't even that 10. It was never really crazy, even as much as this was right here. So the VIX was moving down hard. There was still opportunity, and you got that snapback on those 2 instances under 10. But after that, you saw that VIX was very, very low. It was the VIX overshoot, not the VIX itself. Was very low. It was trying to regulate, but S&P was still going down. It was still down here in this negative 5% thing, and the VIX was not reacting the same. So in this red box, when you see it kind of correlated going in the same direction, this is an indicator that the option market makers are not in control of this market. This is not something that they are doing.
Explain that? What do you mean by that? So now,
at this time, this is when I think it was 320 or 321 is when the Fed started stepping in and started making. They were the liquidity providers in the market. All of a sudden, they did the SLR, maybe not the Fed themselves. They started moved interest rates to 0 immediately. They expanded their balance sheet very swiftly, and they started giving capital exemptions to banks, the SLR exemption. So, and then they started even buying corporate bonds. They were providing liquidity to the market and not the option market makers. So what was happening was credit was becoming easier in order to sustain businesses. And, so all of that is nothing to do with the option market makers. I mean, yeah, I'm sure there's some people that are, buying a lot of puts, or, they're trying to hedge, and, but the option market makers were not in charge of the liquidity at that time. So that's when, you kind of have to, I don't like to give this binary, when this happens, then you must do this. You kind of have to see especially with something as broad as the S&P 500, you kind of have to see the full picture of what's going on in the market. You don't want to, in that red box, it's a good time to kind of stand back and say, all right, let the big, Jay Powell, the Fed president, let's let them all, get things straightened out. And then once this relationship starts acting the way I'm expecting it to again, then I can start re-entering the market and, and be much more confident in what I'm doing.
Right. So is this a main indicator for you?
It is one of them. Yeah. This is probably the one thing I look at more than, to determine near term, should I start hedging heavier,
Sure.
or should I lighten up on my hedging or something like that?
Got it. Okay. Wow, that's great.
But this is um, something that I think people should know about and incorporate it into their market analysis. And it's also something you don't hear very often.
Mm-hmm.
So, I mean, you just kind of hear VIX going up and VIX going down and S&P going the opposite direction.
Right.
And sometimes you have to ask yourself, is this something that's supposed to be happening?
Mm-hmm.
Over the past, I mean, just to give kind of a overview of what I've seen over the past couple of weeks, VIX has, within that 0 to 2 range, VIX has been overshooting little by little the S&P 500 moves.
Right.
For a while, I think today VIX was positive when S&P was positive. It's a little bit of an overshoot.
Right.
You don't really know how it's going to resolve yet. Is it going to be the S&P dropping, or is it going to be the VIX dropping?
Mm-hmm.
But it's a good, if you want to trade maybe both the S&P and the XX,
Mm-hmm.
do a dispersion trade, long both of them, or
Right.
short both
Cool.
of them.
Mm-hmm.
But when you see that, that kind of relationship, it gets me to thinking it might be time to hedge for the next couple of weeks, or it might be time to start thinking about doing something a little different rather than just long in the market.
Mm-hmm.
So
that indicates then you hedge the long market portfolio with
right.
however you like to do that. Okay.
Yeah.
Wow. And these tools, they're not out there. They're not out there in the marketplace for common retail folks to get to. This is stuff that is developed in quant shops and institutions, right? And Jason's head.
I mean, I'm honestly, like, when I told you my introduction, I never worked, in a Wall Street quant shop. But I just kind of, I do have some quant friends, and we talk a lot. And, so I get some ideas, and I get some, I run my regressions and do what I know how on it, and then try to find the relationship and form a trading plan around it.
Mm-hmm.
So that, it's, kind of an iterative process. But this is just something that, because of how correlated it is, I feel like it's something important for retail traders to know, so that they can make more informed decisions in their investment and their trading.
That's great. Okay. I think we should probably stop here. I know we talked about doing this in 2 pieces. Let's do that.
Okay.
And do because I know what the rest is, and I think that's going to take a lot of time. So let's stop on this one, and we'll pick it up here. You wanted to show a few
I'll show
things.
There's your quick preview. The last 3 seconds was a quick preview of the rest of the thing, of the rest of the story.
Right. So we're going to talk about Gamma and Vana.
Yep.
And then some of the automated options trading strategies. And then you wanted to give a shout out to a few folks as well, right?
Yeah. So my first, my company is AdDam Funds, AD space DEUM space funds.
Mm-hmm.
AdDamFunds.com is our website.
Mm-hmm.
All our contact information is there. You can send us a note if you're interested in investing with us. I also have a monthly newsletter. I call it the Wizard of Ops. Basically, I combine all my sources, the data-driven sources that I use, and I try to give a comprehensive layout of macro trends, fundamental market trends. I give I pretty much every newsletter, I give some ideas over the next month to 3 months of trades to do based on all the metrics that I have. So that's a monthly subscription.
Okay.
Squeeze metrics we'll talk about later on, because they contribute a lot of the metrics that I have in the second half of my presentation. And I contribute. I give daily volatility kind of commentary about 3 times a day on the EcoQuant Insight website. And EcoQuant himself, he does a lot of data analytics on the markets themselves,
mm-hmm.
and on the stock. So all the time, just ask him, what kind of data analytics, not technical stuff, not like double bottoms and stuff, but he does data analytics. So I contribute to his site because I do the option analytics.
Okay, great. And then the top 3 are those are all subscription.
So, yeah, everybody, all of them are subscriptions. The ad dam funds is an RIA, so it's, that's kind of more of a financial management
Right.
thing.
Right. So you're an advisor. So you manage money essentially, right?
Yes.
Okay. Great. We'll put all that in the video as well too, so folks can get it there as well. Okay.
Great.
Awesome, Jason. I'm gonna take you off the screen share here, and we're gonna say goodbye. But that was terrific. Look at, I love talking to folks like you, because I think most, and again, I'm in the retail world now, right?
Yeah.
So most people, especially in the retail world, don't have access to this sort of content. And we talked earlier before we went live here. People want to know what this means to them. How do they use it? What's the lever they can pull? Clearly they can do stuff with you, but the more understanding folks can get, the better off they're going to be with their investing / trading success. I mean, the education part in this world today is just unreal, and you really have to pay attention, I think. So this is really great stuff. I appreciate you doing this for us.
Yeah. No, thank you, Lex, for having me on.
Okay, good.